Next time you open your mail and see your car insurance bill, I want you to do something. Don't look at the road. Don't look at your driving record. Look at the courtroom. You've probably noticed the number on that statement has been creeping up, or maybe it's just taken a giant leap. We're talking about a 22 to 26% jump in auto insurance premiums for the average driver. And if you've got a clean record, you're probably asking yourself, why am I being punished for everyone else's bad driving? Well, here's the deal. It isn't just about bad drivers. It's about something far more invisible and far more expensive. It's what economists call a litigation tax. Right now, the total annual cost of the U.S. tort system, that's the system of lawsuits and liability, is sitting at a staggering $443 billion. Let that sink in for a second. That is over 2% of the entire U.S. GDP. It's basically a massive hidden tax that every single American household pays, whether they ever step foot in a courtroom or not. Now, you might think, okay, big companies get sued. They pay up, that's just how it works. But look at the trajectory. This isn't just a cost of doing business anymore. It's a systemic drain that's accelerated by 38% in just 3 years. We're seeing a shift where a simple fender bender or a slip and fall isn't just a legal dispute. It's becoming a high-stakes investment asset. Here's where it gets strange. Most people think of a lawsuit as a way to get made whole after an accident. But in the world of high finance, your right to sue is now a commodity being traded by people who weren't even there when the accident happened. So here's the real question. If your neighbor gets into a legal battle and walks away with a massive payout, who do you think is actually writing the check? It isn't just an insurance company's extra cash. It's the premium you paid this morning. It's the price of the groceries you're going to buy tonight. But what if I told you that lawsuit isn't just a local dispute, but a calculated move by a hedge fund in London or New York? If the world's largest investors are suddenly betting on the outcome of car accidents, what does that tell you about where your money is really going? Let's break down the engine behind this. It's called third-party litigation funding, or TPLF. I know it sounds like dry legal jargon, but it's actually the most aggressive financial innovation in the legal world in a century. Imagine a hedge fund looking at a lawsuit the same way they look at a tech startup. They see potential. They provide the cash to hire the most expensive experts, run the longest trials, and refuse any settlement that isn't a lottery win. They're providing the dry powder, about $15 billion of it, to make sure these cases don't just settle for what's fair. They settle for what's nuclear. We're talking about nuclear verdicts. These are jury awards that top $10 million, and they're exploding. Last year alone, we saw 135 of these verdicts, a 52% jump. The average amount? $51 million. Think about that. Juries are handing out $50 million checks for accidents that used to be resolved for a fraction of that. And this isn't happening by accident. It's a calculated strategy using something called reptile theory. Here's how it works. Instead of focusing on the facts of the case, lawyers are trained to trigger the primitive part of the jury's brain, the reptile brain. They focus on fear, on community safety, on punishing the evil corporation. It's incredibly effective, and when it's backed by a hedge fund's bankroll, the defense doesn't stand a chance. The funding allows the plaintiff to hold out for years, refusing reasonable offers, because their bills are being paid by an investor who's looking for a 30% return on their legal asset. So you have to ask, if a legal claim is now a tradable asset, who's actually in charge of the justice system? Is it the judge? Is it the jury? Or is it the guy in the suit at the back of the room who's already calculated his ROI before the first witness even takes the stand? If juries are handing out $50 million checks, who is actually cashing them, and how did they make it more profitable than the S&P 500? Now let's zoom out for a second and look at the players. We're talking about giants like Burford Capital. This isn't a law firm. It's a finance firm listed on the New York Stock Exchange. In 2024, they reported realizations that outperformed almost every traditional asset class. We're talking about internal rates of return in the 25 to 30% range. While your 401 Kia was grinding out single digits, they were making a killing on social inflation. What is social inflation? It's the mechanism that forces insurance companies to pay more for claims than they ever predicted in their actuarial models. When a jury awards $50 million for a case the insurer thought was worth $2 million, the math stops working. And when the math stops working, the insurer has to buy reinsurance to protect themselves. But the reinsurers are looking at these nuclear verdicts and raising their prices too. It's a feedback loop that eventually lands right back in your wallet. Social inflation now accounts for about 7% of all insurance losses. That sounds like a small number, but in a multi-trillion-dollar industry, it's a massive drain. This is why commercial auto insurance loss ratios are hitting 105%. That means for every dollar they take in, they're paying out $1.05. They're losing money on the core business because the courtroom has become a casino. And honestly, this is the most interesting part of the whole story. The investors aren't even hiding anymore. Sovereign wealth funds and private equity firms are pouring into this space because it's uncorrelated. It doesn't matter if the stock market crashes or if interest rates go up. People are always going to sue each other. It's a perfect hedge for them, but a perfect trap for you. Is this modern financial genius finally giving the little guy a fighting chance against big corporations? Or are we just repeating a mistake that medieval kings saw coming 7 centuries ago? Let's take a quick trip back to the 1300s. Back then, if you funded someone else's lawsuit for a profit, it was a crime. They called it champerty or maintenance. The idea was simple. The law should be for justice, not for profit. If you allowed third parties to buy into lawsuits, you'd end up with legal harassment, wealthy people weaponizing the courts to shake down their rivals. For hundreds of years, this was the standard across the Western world. But in the late 20th century, we started relaxing those rules. The argument was all about access to justice. The idea was that if a poor person had a legitimate claim against a giant company, they couldn't afford the lawyers to win. So litigation funding was supposed to level the playing field. It sounds noble, right? Christopher Bogart, the CEO of Burford, argues exactly this, that they are the great equalizer. But look at the data today. Is that what's actually happening? Jerome Hegeli, the chief economist at Swiss Re, sees it differently. He calls social inflation a systemic threat. He argues that this isn't about the little guy anymore. It's about institutionalizing strife. We've gone from prohibiting third-party funding to making it a $23 billion global industry. We've turned the scales of justice into a slot machine, where the house always takes 40% of the winnings. The access has been bought, but the justice is getting harder to find. Think about that next time you hear about a record-breaking settlement. Is that money going to the victim to rebuild their life? Or is it going to a glass office building to pay for a performance bonus? As the pool of legal dry powder hits record highs this year, what does the trail of paper mean for the future of your retirement and your next doctor's visit? So, where does this end? Right now, there's an estimated £8 trillion, that's over $10 trillion, of aggregate market cap exposed to class action and collective litigation globally. This isn't just a US problem anymore. It's spreading across Europe and the UK like wildfire, and as that exposure grows, companies have to raise their prices to cover the risk. It's a self-fulfilling loop. Higher verdicts lead to higher prices, which lead to higher jury expectations, which lead to even higher verdicts. This litigation trap is quietly eating your savings. It's in the 30% spike in your consumer premiums. It's in the rising cost of healthcare as doctors pay more for malpractice insurance. It's even in the price of a gallon of milk because the trucking company delivering it is paying double for their insurance. We're living in an era where the dark money of the law is the most powerful force in our economy, and almost nobody is talking about it. The path forward requires transparency. Right now, in most courts, you don't even have to disclose if a hedge fund is funding your case. The jury thinks they're helping a person when they might actually be padding the quarterly results of a specialized investment fund. Without transparency, the justice system stops being about right and wrong and starts being about the ROI of silence versus the cost of a nuclear verdict. The scales of justice are no longer weighing right and wrong. They are weighing the return on investment of your silence against the cost of their next record-breaking payout. So next time you see your insurance bill, don't just complain about the number. Ask yourself who's really on the other side of that check. If the system is designed to turn your accidents into their assets, who is the one truly paying the price?